Hi, and welcome to this week's episode of Retire Right with Epstein White. My name is Brad White.
I'm David Epstein.
And Dave, how are you today?
Fantastic, Bradley. Excited for this show. I think we got a lot of great content for our viewers today, and I'm anxious to get it started.
Well, I certainly hope we do, and I feel the same way. I'm excited, and I think we got a lot of great things to teach you. I think we do every week, but just especially excited this week, Dave. And we're going to start off on our viewer question of the week, which is a great one, and it's how do we generate income from all of our investments and our portfolios in retirement? So we're going to talk about that. Then we've got our weekly retirement alert for you, and this week's retirement alert is all about what your taxes are going to look like in retirement, and maybe even more importantly, what they should look like in retirement and how we can minimize them for you.
We're gonna be talking about Wallstreet and really going against what a lot of financial firms might be recommending to you out there. And really, what is in your best interest? Are they the same? Or is there a conflict there? We're going to talk about that. And we're also going to talk about this rule of 100, this rule that goes back generations, kind of a boilerplate, kind of a rule of a thumb kind of rule. But we're going to talk why and explain why that could be not a rule you want to follow. So why don't we get this show started? Well, the retirement myth, the rule of 100, well, that's the theme of each show that you're going to watch here at Epstein & White, is teaching you, giving you the proper education, arming you with the information that you need to make intelligent decisions. And this rule of 100 was thought to be a rule of thumb that everybody should follow. And so let me give you an example. If you're 70 years of age, you would take that age and you would subtract it from 100, and that would lead you to believe that 30% of your portfolio should be in stocks, and the balance of the portfolio, 70% of the portfolio, would be in bonds. Bradley, I'm not sure that's a good idea. I mean, you'd have to go back, folks, to the 1940s to find an interest rate period that's this low, and having all your money, or a good large part of your money, 70% of your money, if you were following this rule in bonds, that could be a horrific idea.
Yeah, and you know what? Just let's actually highlight a little bit as far as what you just said, as far as interest rates and how low they really are. So I want you to take a look at this image that we've put up here on the screen, and you'll see that this is what interest rates in general have looked like in our country from 1948 through 2014. Now, why does this chart stop at 2014? Because unfortunately, with what interest rates have been doing, haven't really given us a reason, right, to have to update this chart. So again, unfortunately, they're still at dramatic, artificial low rates. But the more important story here is this. If this rule of 100 was developed, and again, it was decades ago, if this was the 1980s and you can get double-digit returns and interest rates on your safe money like CDs and bonds, then why wouldn't you want to have 70% of your money in something like that? It would have made all the sense in the world. More importantly is this. When interest rates go down, bonds make money. But when interest rates go up, bonds lose money. Now, it depends on what type of bond you have as far as maybe how much they might lose. They do react a little bit differently, but as a general discussion here, just know that when interest rates go up, bonds lose money. So Dave, again, 20, 30, 40 years ago, not only were you making more interest on all of those bonds, but you didn't have to worry about losing a bunch of money. Yeah. Today, if interest rates are this low, would you really want, in this example, 70% of your money in something like bonds that aren't going to pay you that much in general, but also that's a little riskier than maybe this rule of thumb would have led you to believe, having 70% of your money in something that might lose if interest rates start to rise here in the coming years.
Great idea, great idea in the 90s, and today, not so much. So be careful of these myths. Right. We want to make sure we're doing everything that's customized to each of you, and just boilerplate advice has hurt many. And so that's something I would encourage all of our listeners and viewers to always be cognizant of.
Yeah, and this speaks to, again, kind of a larger issue, right? Which is that it's impossible for a rule of thumb to always be right. Again, the time period that we live in now is just vastly different. That's the first example we gave. But what about just your own individual situation? Age doesn't dictate everything that we do. Far from that. Now, yes, as you get older, more often than not, it makes sense and it's prudent to maybe shift to being more conservative. So certainly there's some parts where age, yes, can have some meaning. But what if I was a 70-year-old and I had, big pensions and Social Security income that covered all of my needs for the rest of my life, and I was okay being aggressive because I'm never going to depend on this money and I want to pass it on to future generations? that means that even though I'm 70 years old, Dave, right, that my money still has a long way to work and I don't mind the risk. So I don't need to have a tremendous amount of my money in something safe like bonds. Versus, let's say, a 55-year-old who wanted to retire tomorrow, who doesn't have huge pensions and who's going to need that money very soon. Even though technically one person's age is 70 and the other person's 55, it's very clear that the 55-year-old who needs their money and relies on it probably should be a little bit more conservative. So how misleading would a rule of thumb be that takes your age only when clearly these people's situations have a lot more going on than just the age part of the equation? So again, kind of a general theme that we do on the show is trying to take a look at these rules of thumb and help you understand that it doesn't apply to everybody. Our situations are different.
Building a plan, folks, that's key. That should be the centerpiece before we start talking about investments. So once we have a plan built, Bradley, then we can understand which are the best investments that go into the plan.
Well, Dave perfectly said, which is that it's all about a customized plan. Hopefully, if nothing else, you learn that there are no such things as rules of thumb that apply to everybody, and you need a specific plan of exactly what tax strategies, what investment strategies, income growth, what is the best thing to do given your situation. If you're looking for help on how to navigate all those areas, if you'd like someone from our office to help build this for you, that's what we're here for. We're happy to do it. Just give us a call, come visit our website, and we'll be happy to build that for you.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wall Street continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
All right, and welcome back to the show. It is time for our weekly retirement alerts. Yep, that's right. Each week we've got an alert that we're going to bring to your attention. And for this week's alert, it is all about what your tax situation is going to look like in retirement. Now, what a great question this is, because I would say for a lot of us, we really struggle to understand taxes, right? Just in general, it's a pretty complicated thing. Most people in this country don't have, let's say the most in-depth understanding of how our tax system works. But forgetting about all of that, during our working years, as we make our income and our paychecks, which is relatively the same on a year-by-year basis, we kind of have an idea of at least what to expect come April 15th every year. And then all of a sudden, we go to retire, and because this whole thing is different, most people really have no idea what to even expect as far as their tax situation in retirement. And that's the whole point of what we're going to alert you to today. Plus, we're going to try to talk to you and teach you, some strategies on how we can minimize your tax obligation in retirement, right? So certainly very important there. Now, before we get into some of those strategies, it's probably important just to understand a little bit of the basic tax structure that we have in our country. So what you're going to see behind me is just a 2017 table of our tax brackets, if you were a married couple filing jointly. Now, let's give you an example and say that this married couple was bringing in $120,000 a year of taxable income. As you can see, that would put them in a 25% marginal tax bracket. But not so fast. Let's make sure we understand that. This is a progressive tax system we have. So even if you're in this 25% bracket, those first $18,650 still get taxed at 10%. Then it's only those additional dollars that get taxed at 15% in that bracket. And finally, it's only those additional dollars after about $76,000 that are getting taxed at 25%. So most people, if you've heard you're in a 25% bracket, don't assume that you're actually paying 25% on all of your monies, right? You pay 10% on those dollars, then 15%, then 25%. So that by the time you actually blend that in, remember your tax rate, what we call your effective tax rate, is going to be a little bit lower. Now, even beyond that, though, we have things like all of the deductions that we might have, right, for some of us more than others. And we've got things like our own personal exemptions or maybe even additional ones if we have kids or other dependents. So the bottom line is even from there, we still get to lower our taxable income down a little bit. Then you want to look at the total amount of tax you actually paid divided by the total amount of dollars you actually brought home, and you'll find that it's well less than 25%, like the example we're using right now. Now, here's where the strategies in retirement come alive, right? Because in retirement, this is really the first time in your entire life you get to choose where you pull your income from, right? During all of our working years, there's not much we can do about it. Each additional dollar we make from our paycheck is just an extra dollar of taxable income getting taxed at higher and higher rates, right? In retirement, we have an income goal, but now we choose where we pull it from. So things like your pensions, as an example, yeah, that's taxable income. Not much we can do about that. But pensions are a beautiful thing, so we're not going to complain either. Beyond that, let's say we started to pull money out of traditional IRAs, right, 401ks, retirement accounts. Well, each dollar that you pull out of those accounts to spend in retirement will add to your taxable income for the year. So the more that you pull out in any one year, right, the higher your income could be, and therefore the higher rates that your 401ks or your IRAs would get taxed at. So you want to keep an eye on this before the year starts and try not to pull out these dollars that are going to unnecessarily push you into higher brackets. But those aren't the only dollars you might have. If you have things like cash in bank accounts and non-IRA accounts, you can re-spend that cash with no tax obligation. It won't be taxable income. If you have things like Roth IRAs, well, now that money plus all of the earnings can come out to you 100% tax-free as well. Now, as far as your Social Security is concerned, this is a pretty complicated subject. We don't have time just in this one segment to go into every detail there, but just know that your Social Security can either be taxed where 85% of the dollars show up on your federal return, or if you can limit other areas, then actually none of your Social Security hits your return, or in other words, it's 100% tax-free. So let's try to make this come alive again with one more image you'll see behind me. And really, this is two case scenarios of the same family, right? So this is kind of an actual tax return being played out. Now, you'll see case one and case two. On case one, you'll see that there's a $21,180 of this kind of income that you see. That's from a pension. So again, nothing we could do about that. Now, on case two, you'll see that number jump to about $71,000 and some change. That's because in case two, they pulled $50,000 out of an IRA, right? So again, when you pull $50,000 out of an IRA, it adds to the taxable income. What you'll notice is Social Security right above it, though. On case two, the IRA money caused more of the Social Security dollars to end up on the return. Where on case one, because we didn't have the IRA dollars, we also had less of Social Security on the return. So there's kind of this doubling effect there. What we do over here not only adds to our taxable income, but it can cause other things to retroactively be taxable when they otherwise shouldn't be. Now, as you just kind of play this return down and you go down both columns, you'll see that they each get to use their deductions and their exemptions. And the bottom line is on case one, they brought in about $110,000 of total income for the year, about $39,000 Social Security, the $21,000 pension, plus $50,000 they took out of their bank. But that $50,000 didn't show up on the return, so you'll see they only paid about $457 of actual tax on $110,000. On case two, they're going to pay almost $14,000 of federal and state tax, which is only about 12.5% off of that $110,000, but certainly much worse than the $457. So this is really just one example, right? We're giving you some basic understanding of the tax system, and more importantly, letting you see on a return how much money we might potentially be able to save in taxes in retirement if we just understand our own situation, the tax code, and which accounts we should be pulling money from in retirement. So again, if you're looking for some tax advice, if you want to make sure your returns are getting done correctly, and if you just want to see how your taxes play out in retirement and how to minimize them, that's what we're here to do. Give us a call, come to the website, and we'll be glad to set you up with some tax strategies in retirement.
Really, against the wall is against Wall Street. And that's what this next segment is all about. And this is really huge. Where you get advice, folks. Who's sitting across from you when they're giving you advice about the rest of your life money? Don't you want to know that the people that are across from you are making recommendations that are in your best interest? Would you want to talk to anybody less than that? Of course not. And so working with a fiduciary that best aligns where you are in life. So if you're a younger viewer who's watching right now, you'd want to find a fiduciary to give you some help that would just help you grow the heck out of your money. It's all about rate of return when you're much younger. But when you get closer to retirement or you're already retired, you want to find a fiduciary that specializes in retirement income planning and all the aspects and the characteristics of retirement income planning, Bradley. Mm-hmm. That's huge. And so there's been a lot of discussion about fiduciaries versus brokers, and I'm happy that this has been a discussion, and it's been out there. It's put out there in the public, and we know you're much more educated about the differences. You know, there are waters that are completely transparent in this advisory world that's out there, and there's a lot of waters in this world that are rather murky. And don't you want to know that you're talking to an advisor where everything is transparent and everything that is being done is in your best interest? That's Epstein White, and I know there's a number of fiduciaries out there right now, and so that's what you want. You want a fiduciary who specializes where you are in life.
Yeah, that's a great place to start, too. The word fiduciary, again, we invite you to certainly come visit our website or call us if you want more information, because it's really important, and just all the things that a fiduciary means and what that means to you. I think another important kind of concept of this segment that we're doing when we say against the wall is we want you to understand how you should be choosing your investments. But once again, as it relates to advice, you know, how are the people that you're getting advice from choosing investments for you? Now, the way that you should be choosing investments is you should be understanding your goals first. So you want to understand things like, am I looking for my money to be completely safe? Is that my number one goal? Versus another person's goal could be aggressive long-term growth. Now, that's a drastically different investment right there. If you're looking for, you know, safety and reliability, then maybe Amazon or Facebook stock isn't right for you. If you're looking for long-term aggressive growth, those could be perfectly fine or great solutions for you. So long story short, or the point that we're trying to make here is your goals first and foremost dictate the type of investments you should be thinking about. You know, other type of goals that I would want you to focus on are things like liquidity, right? Do I need my money anytime soon? Could I need this money real soon? Or is this money that I've earmarked to not need for a 10 or a 20-year period of time? Certainly, Dave, there are other things that are important, like tax situations. I think risk tolerance is a very important one, too. Okay, right. Just because something like a stock might be great, if it's really volatile and it's really risky and you're just not comfortable with that, then guess what? It's not the right investment for you.
I love the way you set me up on this, Bradley, because it just comes all the way back to, folks, a plan. You know, how do you know where an investment is going to fit and how you're going to use it? How do you know how to build a house if you don't have a blueprint? Retirement is the same way. You need a plan as the centerpiece. Then you can identify what are the appropriate investments that you already have, or where have there been areas of value that have been overlooked. And so once you have this plan built, how to maximize Social Security, how to maximize a pension if you're so fortunate to have one, or we'll teach you how to create one too. And so all of this, Bradley, really goes into a plan. And that's what really, to wring every nickel out of Social Security and the rest of retirement, you need that plan.
Yeah, and so again, really, unfortunately, a lot of what Wallstreet does as this segment goes, which is against the wall, is a lot of places have kind of a predetermined investment. You know, hey, this is our favorite investment.
Right.
And basically, regardless of who comes through the door or what your goals or your situations are, we're going to justify putting you into that investment. And frankly, we consider that completely backwards. First and foremost, all of us are different. Our risk tolerances, our goals, our needs. Focus first and foremost, on those characteristics first. Then we back into the investments that best fit those needs. We really don't want to do things the other way around. And Dave, we would really caution people to get advice from someone where you know that anybody that walks through the door is getting the same investments, because all of our situations are drastically different. Well, as you can certainly see, that's just a few of many things you need to consider in order to make sure you pick the right investments for your specific situation. And if you're looking for some help to do that, we are happy to help. Give us a call, come to our website, and we'll help you navigate through your own investment decisions.
What now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wallstreet continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Social Security is something that impacts almost all of our retirement plans, and it's incredibly complex to learn all of the rules, all the strategies, all the options. not to mention how it implicates your taxes or investments and everything else in your retirement plan. Here at Epstein White, we are experts in how to navigate through this difficult Social Security conversation, and we have an incredible team ready to help you on how to choose Social Security correctly. So take a look at the number below, come see our website, and we're looking forward to seeing you and helping you navigate through your Social Security decisions. Well, hi, and welcome back to the show. And you know, Dave, this show really is all about you, the viewer, right? Each and every week, our mission, our goal is to try to talk about whatever it is that's on your mind and whatever it is we think we can do to help you out the most. And there really is no better way to do that than when you visit our website or call in and you actually tell us what questions you have. And so each week we have a viewer question that we like to tackle. And this week our viewer question may seem like kind of a broad one, but it might be one of the most important questions you'll ever ask as you head into retirement, which is just simply, how do I turn all of my investments into an income stream that I can actually live off of every month? I mean, Dave, again, that's kind of what this whole thing in retirement is all about, right?
It's all about income, folks. And that's what this Retire Right show is all about. When you go off into retirement, how do you take what Bradley just talked about, all that you've worked so hard to accumulate, all you were tasked with was just growing the money, rate of return. Now, Bradley, how do we take that rate of return and turn it into income?
Perfectly said. So let's get right to it. And one of the first things you want to do, and here's kind of the step-by-step, I guess, is how you want to get this done. First and foremost, just try to get a good understanding and really know exactly what your overall income goal is on a monthly basis, right? So just when it's all said and done, for you or you and your spouse, how much do you need to live the way you want to each month? Then from there, you'll want to start adding up things like your pensions or your Social Securities, right? Income that's going to already be coming in. And then that usually leaves you with a gap, right? It doesn't get you all the way to your goal. So now that you know what your gap is, that's what you need to fund through all of your investments. And of course, a little accounting, you'll want to know, what the value is of all of your investments and try to separate them by account as well. So understanding maybe how much of that is in things like your IRAs, which gets taxed one way, how much of all of that is in things like maybe Roth IRAs, which are tax-free, or even non-IRA accounts in general. So, and we'll come back to that part in a moment. But again, the step-by-step process, really just understanding what your overall income needs are, what's already coming in, and therefore what that gap is you need to fund, and what the size of your portfolios are. And that gives you an idea, Dave, just does the math even work based off how much I need to fund that gap and what the size is of my investments? Can I even get that done? Now, assuming mathematically you can get that done, there's really 3 income strategies we like to teach people in retirement. The first one, Dave, being flooring, right, which is really just taking some of your investments and creating a good guaranteed income floor, right, something you could stack on top of things like those Social Securities.
Yeah, no question, Bradley. Flooring is huge in helping you create that monthly income that you can count on each month. Something to where you could stack this additional income on top of Social Security, okay? And so we take a little bit of our money, and depending on which is the account that's best to take it from, whether it's from an IRA or a non-IRA, is that we create this extra maybe $500 a month, $1,000 a month, could be a couple thousand a month. And so of that money that we're stacking onto our Social Security on an income that we know we can't outlive. And boy, does that take a lot of stress off the rest of our investments, Bradley. When we got this fixed income coming in on top of Social Security, then it makes everything else a little easier to get income from.
What a comforting feeling, right? Now that you're in retirement, to know at least, hey, this one part of my investment's right here. I mean, this is guaranteed. This is something I can depend on for the rest of my life. So that's what the word flooring means. You're just using some of your money to kind of create another guaranteed income floor, if you will, from your investments. The second strategy is more of a traditional one, dividends and interest, right? We've already talked on today's show on how low interest rates are, so this is a more challenging strategy to do in today's low interest rate environment. But you can still certainly go find a good, high-quality basket, Dave, well-diversified, kind of high-quality, dependable stocks and high-quality, dependable bonds. And if you get that nice, diversified approach, you'll still get a pretty good interest in dividends, something you can collect as income every month. And the benefit with that strategy is it's kind of easy to maintain, where you just collect those dividends, those interest, and your principal is not only staying intact over time, but ideally it's designed to keep growing with things like the stocks over long periods of time, which helps you with your inflation. Now, the third strategy is called a laddering strategy, and it's really about putting your money in a time sequence. So you can kind of carve off some money that you would use earlier on in retirement, put that in something safe, something liquid. It's not going to earn a great rate of return. You're kind of going to spend that down. But what it does is now you've got these long-term accounts, these monies you've identified you won't need for maybe 10 years or 15 years or 20 years, Dave. And that allows you to kind of ride out some short-term fluctuations. Maybe that's where your market investments go, because you won't need that money in the short term and over any long period of time. Again, another great way to keep your principal growing over time and to help with things like inflation.
And that also helps, Bradley, and when volatility comes, inevitably it will, when you got that long-term money, and yes, it's subject to volatility, well, it's long-term. And that allows you to keep your powder dry when volatility comes, because that's money you don't need for 10 years, Bradley.
Yeah.
So laddering is really a powerful tool.
Now, as you can probably see, each of these strategies has some kind of positives, some things it does well, or maybe an area that it lacks in a little bit. So let's give you a good example of maybe an actual couple here and how you could combine these strategies and actually create this income, right, for retirement. Let's say we had a 65-year-old couple. They wanted $8,000 a month total. $7,000 was the essential expenses, the final $1,000, a little bit more of their play money. Now, let's say they had $6,000 already coming in from things like their Social Securities. They're trying to get the other $2,000 from their investments. Let's say they have $800,000 total. A little bit of math here is you could take $240,000 of the $800,000, fund a flooring strategy, right? That's going to guarantee them $1,000 a month for the rest of their life. They take $300,000, put it in a diversified pool of stocks and bonds, which creates dividend and interest of another $1,000 a month. Now they have the entire $8,000 covered forever, and the remaining $260,000, they've got this ladder strategy where they know where they're going to grab additional monies from if they need it, and where their long-term accounts get to keep growing and handle inflation. So that, Dave, right there is a great example to answer our viewer question of the week, which is how do you generate income from your investments in retirement? You want to understand your personal situation, you want to understand strategies in general, and then ultimately you need to get that help on which are the right investments to fund each of those strategies now that we've picked them. And so if you're looking for that kind of help, if you want to figure out how to generate income efficiently in retirement for you, that's what we're here for. That's what
Absolutely.
our firm does for you every single day. So give us a call. You'll see the number right there on the screen. Visit our website and we'll be happy to help build that for you.
Well, that's all the financial fun that we're going to have for you this week. Bradley and I enjoyed giving you this education, and that's the theme of Retire Right with Epstein White. So stay tuned, keep watching, and we'll help you do just that, retire right.